Good day, students, and welcome to our taxation class. In the last class, we had two questions solved from the Insight March 2024. We solved, one of them was question number 4, and the other was question number 5. In question number 4, we solved tax liability for an income earner. That was in question number 4. Then in question number 5, we looked at computed income for people who are beneficiaries to a settlement, trust, and estate. So that's that. The next question we are going to be solving is question number 6. And let's look at this question. So let me indicate that this is a new question I'm about to solve now. So I will start indicating it with this. Wow. So this is question number 6. So let me roll this line off to show that this has been fully done. So we have Insight, March 2024. So this is question number 6. Question number 6, the name of the company is Turn by Turn. Turn by Turn by Turn Limited. Yeah, Turn by Turn Nigeria Limited. Nigeria Limited. That's the name of the company. So let's see what is required of us. Turn by Turn Nigeria Limited is owned by Nigerians and has been in business since 2018. Since 2018. So the result of the company as at 2020 December 31 as the basis period is as follows. Now this is the things that the company has. Assets employed. So they have this is their balance sheet. Their non-current asset is 180, and we have their current assets 550, and their current liabilities is 360. When you less it from the current assets, we have 190. When you add 190 to 180, you have your net assets. And financed by the share capital is 140 million, reserves 60 million, general reserves 100 million, long-term loan 70, all gives us 370 million, which is corresponding with the net asset. And you were provided with the following additional information. Revenue of the company during the year ended 31st December 2020 was 240 million. So this is the revenue. The gross profit was 335 million. Accessible profit is 2.1 million. Unrelieved capital allowances brought forward from 2020 year of assessment was 300,000. Capital allowances for 2021 year of assessment amounted to 800,000. you are required to compute the company's minimum tax for 2021 year of assessment. Minimum tax. Then to compute the company's income tax for 2021. So, minimum tax. The company's minimum tax in 2021, according to New Finance Act 2019, the minimum tax changes to 0.5% of your gross revenue. Then 2020, the minimum tax requirement now changes to 0.25% of your revenue, which could be applied either in the year 2020 or 2021. Which could be applied in 2021 or 2022. So that is for the benefit of those who are facing COVID-19 and their revenue was, small. Instead of taxing them the minimum tax to be 0.25. So for this year, any of these 2 years, you can apply 0.25%. So the normal minimum tax, which is MT, is supposed to be 0.5%. But now for 2021, we could use 0.25%. So that's what we are going to be using here for the minimum tax. So what do we do now? We'll go to the question and attack it now. So let's start solving it. So minimum tax for 2021 year of assessment. That is what we are looking for right now. So how do we get our minimum tax? So this is gross revenue. Our gross revenue is 240 million. So we have 240 million. So that's your gross revenue. Minimum tax 0.25% of gross revenue. So that would be 0.25 over 100 times 240 million. So what would that be? Let's activate our calculator. Right? So that would be 0.25 divided by 100 multiplied by 240 million. That will give us 600,000. So 600,000 will be the least tax, which is the minimum tax that the company is expected to pay. So that's the A part of the question just answered. A part is minimum tax. Now the B part of the question says, compute the company's income tax liability for the assessment year. The income tax liability. So the B part, let's start from here. B, income tax liability for year of assessment 2021. So this is what we are going to be looking for. So what shall we do? We'll look at, normally we are supposed to start from revenue and start going down, but we have gross profits, we have revenue, we don't have cost of sales, but of course we have gross profits. After getting our gross profit, we don't have operational expenses to get net profit. But thankfully, we were given accessible profit. So this is our starting point here. Accessible profit is 2.1 million. So that's where we start. Accessible profit 2,100,000. 2,100,000. Accessible profit 2,100,000. Then the next thing is, after your accessible profit, what do you do? If you have loss from the previous year, you can bring it forward. We have no loss from previous year. So what do? We need to bring our capital allowance. So we will now bring capital allowance. Capital allowance brought forward from previous year. Let's see, the question give us capital unrelieved capital allowances brought forward from 2020 year of assessment. It was 300,000. So we'll bring it out here. 300,000. Then the capital allowance for the year. I'll call it capital allowance for the year. How much capital allowance was incurred for the year? It was 800,000. So that's what we are going to use. 800,000. When you add this up together, you have 1,100,000. So this is capital allowance claimable. So this is your capital allowance claimable. Do you have enough profits to claim this capital allowance? Now, the company is we are not told what the company is into, so we can check whether so this capital the capital allowance charge will not be capital allowance charge should capital allowance charged. Let's check if 2/3 of 2,100,000 is either bigger or smaller. So I will say 2/3 times 2,100,000. That gives us 1.4. So 2,100,000 2 2/3 of 2,100,000 is still bigger than the 1.1 million. So what will happen is the whole 1.1 million will be charged. So it means this 1.1 million will be charged. So we'll take it down here too. So your capital allowance charged is 1.1 everything. So capital allowance carried forward here is dash. So no capital allowance is carried forward. Now what we have here is taxable profit. Our taxable profit, when we remove 1.1 million from 2.1, we have 1 million here. We have 1 million. 1 million is your taxable profit. Okay, so your company income tax at 30% of taxable profit. So 30% of 1 million should give you 300,000. So this is your company income tax. You are going to be comparing it with your minimum tax. Minimum tax we calculated before is 600,000. Minimum tax here is 600,000. So you calculated from your operation, you calculated 300,000 as your minimum company income tax, and you calculated minimum tax to be 600,000. Now, normally, since your minimum tax is bigger than your company income tax, minimum tax is bigger than your minimum tax is bigger than your company income tax, your minimum tax is supposed to be the lowest tax you should pay. So we are supposed to take 600,000 as our company as the tax for the year. But look at the company information. They said they have been in business since 2018. So between 2018 to 2020, it's how many years? 18, 19, 20. 3 years. So any company, this is 3 years, any company that is within 48 months, which is the same thing as 4 years, they are exempted from minimum tax. So we will say here that tax liability should be 300,000. That's what we'll check. So I'll put a note now. Note. When computing tax liability, we compare CIT, which is the company income tax, with minimum tax, and we choose the higher. Okay? Minimum tax is supposed to be the very lowest tax that a company it should be the lowest tax that a company should pay. However, turn by turn Nigeria Limited is less than 48 months in business and is exempt from minimum tax. Hence, the company should pay the CIT of 300,000 as its tax. So that's it here. The company is supposed to pay 600,000, which is a higher figure between 300 and 600, but because they are exempted from minimum tax, then they cannot pay the 600, then they will now fall back on the 300,000, and that is what the company should pay. So that's how this question is being solved. Okay, so this tax liability we calculated as 300. We're supposed to also calculate tertiary education tax. Tertiary education tax is supposed to be 2% of assessable profit, which is the same thing as 2% of what was the assessable profit we had here, 2.1 million. So 2,100,000. So when you look for 2% of that, 2 over 100 multiplied by 2,100,000, so you are to pay both 300 and 42,000. So that's what you should be paying as your tax. Let's now look at another question here, which is from Insight of September 2023, question 6. So let's go. So this is Insights, September 2023, question number 6. So we're going to look at, this is Mogaji Limited. Mogaji Limited. So we're looking for compute the adjusted profit for the company for the year ended 31st December 2021. Adjusted profit. We have to compute adjusted profit for the year of assessment 2021. That is what we are asked to compute. All right, so what do we do? Now, Mogaji Limited is a Nigerian company engaged in the production of plastic products in Apata, Oyo State. The company's account for the year ended 31st December 2021, that is years of assessment 2022. It's year of assessment 2022 because we just told that the basis period ended in December 31st, 2021. So it's year of assessment 2022. So what they meant here is year of assessment 2022. That's fine. It disclosed a net profit of 10 million. So when you are calculating your adjusted profit, you start from your net profit. So what you will do now is we've gotten our net profit. So that's our starting point. Net profit reported. This is 10 million. 10 million. So this 10 million net profits can never be the assessable profit or adjusted profit. We need to adjust it. So what are we adjusting it for? They said we got this 10 million after we've charged salaries. Salaries is an allowable expense. That's fine. So we have no issue with salary because it's an allowable expense. So rent paid on MD's accommodation, we'll be worried about this. Depreciation, it was charged 1 million. We'll have to add it back. So let's add back all the things that are not supposed to be allowed. You add back. What are we adding back? Start with depreciation. Depreciation. How much is depreciation that we are adding? Depreciation is 1 million. There's 3 zeros up here. So depreciation is 1 million. So we'll write our 1 million here. What other things are we adding back? Fines and penalties was removed. We are going to add them back. We are not supposed to have removed fines and penalties. So this 200,000, we'll add it back. Fines and penalty. Add them back. 200,000. Is that the only thing we're adding back? Now, they said it was disclosed that the annual basic salary of the company's managing director is 1.5 million. Wow. While the other allowances amounted to 4 million. So, if you're going to be paying rent on the MD's accommodation, it is allowable that the rent should not be more than 100% of his basic salary. So this should be 100% of basic salary. So that means we have paid excess. We have paid excess. So what should we do? Let us find the one that is excess and we disallow it. So you will now say rent on MD's accommodation. We've paid 3 million. So less allowable rent. Allowable rent. And we said Allowable rent is 100% of basic salary, which is the same thing as 100% of 1.5 million, because we are told that his salary, the basic salary of the MD is 1.5 million. So 100% of 1.5 million is 1,500,000. So this is the allowable part. So 3 million minus 1.5 million, that means the part that is not allowable is 1.5 million. So now we've gotten all our disallowable. 1.5 plus 200, 1.7, 1.7 plus 1 million, that's 2.7. So this is, call it 2,700,000. So this is your total disallowable expenses. So this is your total disallowable expenses. Sorry, we're adding them back. We're not lessening it, adding them back. So when we add it to our 10 million, it means we have 12, sorry, it's going to be 12 million. So it's going to be 12,700,000. So this is going to be your adjusted profit. So the adjusted profit is your net profit, or your net profit. You add back all the things that are not supposed to have been deducted. You add them back. We said here depreciation is not supposed to be deducted. We add it back. Fines and penalties are not supposed to be deducted. We add it back. Then the rent of the MD, they went to deduct 3 million, whereas we're supposed to have deducted 1.5. So the excess 1.5 that was deducted, we add it back. So everything add backs 2.7, and that will increase it to 12,700,000. And that's what we have as our adjusted profit for the company. That answers the question. Now let's take one more. Question number 5. Now this is a partnership. Alamu, Bembo, and Logo, I'll just call them ABL, has been in a partnership as professional builders for more than 10 years. The operational results of the partnership for the year ended June 30, 2021 is shown below. Look at the gross profits gotten from partners. They deduct salaries, wages, transportation, everything, and they got net profit for the year. Net profit for the year happens to be this. Now, other relevant information, we have allowance for doubtful debt was based on 20% of debts over 10 months old. Okay. Allowable doubtful debt, they said, was based on 20% of the debt of 10 months old. There's nothing wrong with that. Office expenses included a donation of 400 to an old people's home. Then capital allowances agreed was 4.7. Then the sharing ratio is 5:7:8. Okay. We are told to compute the income of the partnership for tax purpose and the capital, the chargeable income of each partner for tax purposes. All right, so let's have a go at this. So we are told to compute the income of the partnership for tax purpose. So what it means is that what is the income that the partners should share for tax purpose? So this is the income that should be taxable for the partnership. So we'll start with the net profit for the year. So let's roll this off. So this is Insight, September 2023, question number 5. So the name of the partnership here is Alamo, Bembo, and Logudu. Alamo, Bembo, and Logudu. So this is partnership. So what are we asked to calculate here? We are told to calculate income of the partnership for tax purposes. So this should be 2022 year of assessment. A partnership income for year of assessment 2022. So that's what we are calculating. So how do we do that? So we'll put our Naira sign. So we'll start with what was the net profit for the year? 4,712,500. Net profit 4,712,500. That's the net profit. Let us add back certain things. Add back. What are we adding back? Let's check. We are adding back. Let's start from here. Allowance for doubtful debt was based on 20% of debt over 10 months old. So this is not allowed. So our allowance for doubtful debt, we'll go and check for it. We are going to take this one out. 325. Allowance for doubtful debt. Allowance for doubtful debt 325,000. That's one. What else? Office expenses included a donation of 400 to an old people's home. So this is not an approved donation. So your office expenses happen to be 700, but now out of it 400 was for old people's home. So we are going to take out this 400 and add it back. Expenses in a bracket donation 400,000 is to be added back. What else? Capital allowances, we'll talk about that later. So we'll go to the body of the question. Salaries is approved, transport is okay, insurance okay, rent and rates okay, talked about office expenses, professional expenses, okay. Allowance for doubtful debt, we talked about it. Staff loan written off. We're not supposed to written that off, so we'll add it back. It was deducted. Staff loan written off, we're adding it back, 135. Staff loan written off, that's 135,000. We're adding it back. And once again, we have depreciation, 3,900,000 is part of it. Depreciation, 3,900,000. Okay, so let's see. Interest on loan, blah, blah, blah. All these are not there. So we've added all the things we are supposed to add back. So let's add all of these together. So we have 325,000. Sorry, 325,000 plus 400,000 plus 135,000 plus 3,900,000. That gives us 4,760,000. So this 4,760,000. So these are the things that should be added back. Then of course we have our capital allowances, which was given us here. We are going to remove capital allowance. Capital allowance agreed with revenue is 4,750,000. 4,750,000. So you will say less capital allowance, 4,750,000. So we are going to less that. This one is already 10,000. Add 10,000 to, so this is 4,722,500. 4,722,500. So that is going to be our, what's the heading here? Income for the year. You can call it accessible profit for the year, or income available for the partnership. So it's either the income available for the partnership, or we can call it, if it is not a partnership, we can call it accessible profit for the year. So let me just call it income available to the partners. So this is income available to the partners. So income available to partners. So this is what the partners are supposed to be sharing. So this is everything, the business. This is what the partners are supposed to share after all the things they've done. So this is what they are asking us: compute the income of the partnership for tax purposes. So this is the income that is available to the partners, which they will share. The second one is compute the chargeable income of each partner for tax purposes. So the B part is chargeable income at partners' hands. So we look at the partners, we say A, B, L. These are the three partners. So the first one is share of profits. So it's going to be this profit we just made here now, 4,722,500. So it's going to be 4,722,500 multiplied by, what is their ratio? Their ratio, this is 578. 578. 578. So 5 plus 7 is 15. 15 plus 5 is 20. So 5 over 20, 7 over 20, 8 over 20. So 5 plus 7 plus 8 gives us 20. So this person will take 5 over 20 of this profit. The other person will take 7 over 20, and this one will take 8 over 20. So that's how they're going to share this profit. So this is the profit here, 4,722,500 divided by 20 and multiply by 5. I will get the first person's own is 1180, 625. So that's the first person. The second person, I'll just do it the shortcut method. Second person is 1652, 1652875. 1652875. The third person, let me use the shortcut, is going to be 1889. 1889,000. So if I were to add these three, I'm going to get back. So let's test. If I were to add it to 1652875 plus 118625. You see, I got back my share of profit. So that's what I was saying. Now, after share of profit, what else is going to them? So you will now check here, interest on loan. So this is the interest on loan by Alamu. This one is going to go to Alamu. Interest on loan. This is amount, this 227,500. 227,500. So you have interest on loan. Interest on loan is going to Alamu, 227,500. So these ones are dash. The next one is interest on capital. Interest on capital. They both all have interest on capital. So I will say interest on capital. Interest on capital. So what do we have here? Interest on capital. Alamu is 112,500. So this person is 112,500. The second person is 157,500. 157,500. And the third person is 180. 180. All right, so what next? So we've dealt with this. All right. So we are done. So what do we do now? We'll now say income at partner's hands. So this is the income at partner's hands. So you add all of this together. So let's see. Take the first person. 1,180,625 plus 227,500. Sorry, 500 plus 112,500. That will give me 1,520,625. So that is the income in the hands of this person. Now let's look at the second person. We have 1,652,875 plus 157,500. So this gives me 1,810,375. 1,810,375. Then the last person here, let's say 1,889,000 plus 180,000. That will give me 2,069,000. So this is the B part of the question, the answer to the B part of the question, and that concludes the question for this particular diet. But you should take note that since these partners are individuals, we will need to compute something called the CRA before we can charge it to tax. So let's compute the CRA before we conclude this question. So we'll say less CRA. So the CRA here is going to be 200. So first of all, we'll say 200,000. So let's come here. 200,000. We have to bring that 200,000 for all of them. Then we'll say plus 20% of income. So 20% of the first income here, 1,526,25, we'll look for 20%. That will give me 304,125. 304,125. So if I were to check this one immediately, this is going to be our chargeable income. Which is what we are asked to find. Chargeable income. So let's do that straight ahead. We have 304,125. If I were to add it to 200,000. So this is our total CRA. If I were to minus it from 152,0625, that will give me 101,000 1, 6, 10, 16, 500. So this is the chargeable income for this person. So let's check the other person's own. We're having 20% of, so let's say this is 1810375. Let's look for 20%. That will give me 362,075. 362,075. If I were to add it to the 500, to the 200, this becomes CROA 562,075. If I were to take away the CROA from 1810375, I will get 1,248,300. 1,248,300. And now let's do the last one now. The last one was the last one. So let's say I want to look for the 20% of 20. Okay. So this 20% of it. That should give me 413,800. 413,800. If I were to add it to my 200 here, that will give me 613,800. If I remove it from my income from the partners, income to the partners, so this is my chargeable income, 1,455,200. All right, so this is the end of this particular question. So we have successfully done 2 diet questions. The first video we did, that of March 2024, and now we've done September 2023. We've done the calculations. Some of these other calculations, like in question number 3, we've done that before. So we're not doing that now. So we've done that before. So we have successfully done 2 diets. So thank you so much for this class. We are going to take further questions in the next class, and we'll see how we are going to solve questions and improve our speed and accuracy in the exam setting. So thank you so much. See you again in the next class.